So markets south of the border up today. It looks as though there's a positive reaction to this trade framework reached between the US and the EU. Let's get more from Martin Roberge, Managing Director of North American Portfolio Strategy at Canaccord. Martin, great to see you. Thanks very much indeed for joining us.
Thanks for having me.
We are going to have these tariffs, aren't we? I mean, 15% on Europe and Japan, and that does add to friction. I mean, I think economists would say that's not a great thing.
But it's obviously lower than the tariffs that were announced on April the 1st. So it's a sign of relief. But what we have to understand is that through those negotiations, something very important has not really been discussed about is the trade deal on Japan is probably like a change in when it comes to the bond market. Like this stock market is holding by the bond yields, and there's no margin of safety for stocks. Like if you get another increase in bond yields, valuation is going to get probably compressed. And what we're not discussing through those trade deals is probably some conversations relative to foreign transaction on those U.S. treasuries. And I think behind the accord of Japan and probably Europe, huge holders of U.S. treasuries, in there's probably an agreement that the pace of treasury selling will moderate going forward, because that's obviously a key risk factor, not only for the U.S. economy, but for the Treasury Department, which is looking for lower treasury yields in the U.S. So just wanted to point this tidbit.
Let's have maybe a look at a 5-year chart for the U.S. 10-year bond yield. I mean, if that went just hypothetically above 5% and stayed there, Martin, would that be bad news?
Well, you would end up with a negative equity risk premium in the U.S., which is something that we saw actually at the peak of the market in February, and then obviously in the 80s and 90s. But it's really rare for U.S. equities to trade at a negative equity risk premium, i.e., like the earnings yield of the index below the bond yields in the U.S. Like we can stay there a little while, but we never really. This is like obviously what we call like the overvaluation zone, or the extreme overvaluation zone for U.S. equities. It doesn't mean it's bad. It's just that going forward, most of the appreciation on the index will be limited to the earnings growth trajectory. Like the P expansion would be over.
You have a couple of charts for us relating to small caps. The first one, looking at the Canadian small cap index, looks great, a successful breakout. But then there's the other side of the coin, still underperforming the big cap stocks.
Yeah, actually, we've seen since the April low, we've seen some outperformance. And the reason why we decided to write about small caps is that we're seeing this. We're kind of stabilizing and trying to break out this 20-year downtrend in Canadian small caps. Like they've been like orphans for nearly 20 years in absolute terms. Like we have just surpassed this year the peak of the index in 2007, while the TSX versus its 2007 peak is already up like almost 80%, 300% for the S&P 500. And while obviously we're happy to see this breakout, we want to make sure that it is sustainable. And when we did some calculations and an analysis, we believe that the conditions are there for probably more than the quarter or two of outperformance. We believe we could have a good 18 months of small cap outperformance in Canada.
The small caps, you say, lean heavily on the energy and materials, so that would be part of a commodity rally story?
Yeah, and well, actually, you need three things for small caps to work. At the macro level, you need rate cuts. Obviously, like the Fed has not moved, but we believe it's probably coming in September as we see a further cooling in labor market conditions. Also, you need GDP growth acceleration. Well, 80% of central banks have cut their policy rates this year. You never see this. You see this only during a recession. So there's a lot of monetary reflation in the system that will filter the economy in 2026. And lastly, you need a weaker U.S. dollar, to boost commodity prices. And the U.S. dollar is down about 11% right now. And when you look back at historical bear markets in the U.S. dollar, it's about 20%. So we would be halfway through. And we have to think that this 20% bear market mark will be seen when you consider that the trade surpluses around the world are about to shrink. And as you know, Andrew, like those surpluses have been recycled into U.S. financial assets, either treasury bills, bonds, or stocks. So to the extent that those surpluses will shrink, the marginal amount of U.S. dollar buying will come down over the next couple of years. So when you have like rate cuts, global GDP growth acceleration, and U.S. dollar depreciation, this is the perfect mix for Canadian small caps.